we'll discuss that as well, Surabhi. But the point about the market is, and I'm going to repeat what I said on Friday, because that data is something which you have to go through now every day. What we have in our market is a stealth bear market once again. What is a stealth bear market? Where the index tells you something else, but beneath the surface, it's a completely different market. This month as well, and this is including Friday's data now, the Nifty is down 0.8%, but the mid-cap index is down 2.5%. The junior, I think Nifty Junior always tells you the kind of pain that is there for the portfolios. That's down 2.7%. And like we discussed on Friday, the monthly advance decline is perhaps going to be worse since Jan 2019. In fact, there's a good chance of this being a market where the monthly advance decline could be worse since, I think, September of last year. And we normally go through a 500, 600 point index corrections once we have this kind of advanced decline preceding the decline. The Nifty was sort of holding that 11,800 to 12,000 range. It's still not broken that, but there's a good chance that this is, the texture of the market has changed from buy on dips to sell on rally. Also, what has happened is that if you see the India versus EM trade, remember all through May we spoke about this huge outperformance for Indian market compared to the emerging market. Now look at the data. What we've essentially done is, while we've gone through underperformance, outperformance, this month it's again India underperforming the markets. And now what that has done this year is, it's now at par. MSCI India is absolutely in line with emerging market and Asia ex Japan this year. So that way, a lot of global cues going forward, starting with the Fed, I think will become very important. Just one last point: if you are a near-term trader, the Nifty is below the 50-day moving average, just below the 20-day moving average. The Bank Nifty has broken it, and the Bank Nifty clearly, it looks like a logical correction towards 30,200 is possible, and perhaps even something which should happen, because it was too overbought. And for Nifty, IT is sort of holding out. There's some bit for defensive buying, and that's why the Nifty is still sort of within the 20-day moving average range. But if that has to break decisively, then perhaps the 50-day moving average of 11,680 is possible.
It looks a bit precariously poised at this point. Just to put a couple of cues on board, important events this week. You, of course, have the Fed meeting that begins tomorrow. So on the 20th is when you'll get the outcome. Now, there is the Fed futures at least point to an 80% chance of a rate cut in July. 20% of the chance is in June. But any indication of a rate cut is something that the market is looking out for. There are other central bank meetings this week as well, Bank of Japan, Bank of England, etc. And then that retaliatory tariffs that came in, from India on 28 US products. Of course, the market perhaps reacted to that. Apart from that, FI is also sold on Friday, so about 240 odd crores there. Domestic institutions bought though. But Anuj, just the contribution to the fall was the highest from financials. Do you get a sense that even if we do see a further fall now, the leadership on the downside will come from financials? And do you think the market has priced in a lot of these global issues, or is there still more to go?
So I just want to make 2 or 3 points. I think on this Fed outcome, on 20th, market would want to go into the event with long positions. But if there's no rate cut, or there's after that the minutes will be released, I think they'll be closely watched out for. My sense is the market will start to prepare for a big rate cut cycle from the Fed, 4 or 5 rate cuts. That is something that perhaps the dot plot will start to indicate, and the minutes will start to indicate. I think on this trade war issue, I think it will be limited. The impact will be limited to few stocks. The market's reaction on Friday was because the market anyway was at the lower end of the range, and it needed just something to push the market. And that sort of acted as a trigger. The market needed some trigger to sort of break down, and the market broke down. I think on this financials, what is most important is, and this is one thing which almost everyone is saying now, if you see the last 1 month data, the market in the financials has become, while the market itself is bipolar, in financials it's the most bipolar. You have HDFC Bank, Kotak Mahindra Bank, Axis Bank, and ICICI Bank. There are 4 stocks which are almost at lifetime highs, and you have Yes Bank, IndusInd Bank, which are at almost 52-week lows. So there was this bipolar nature. I think on Friday what happened was that even stocks like Axis and HDFC Bank, Kotak, they started to slip a bit. That is one area that you want to keep an eye on. Yes Bank, IndusInd Bank, etc. They are problem point for the market. You keep an eye on stocks like Axis Bank. HDFC Bank, ICICI Bank. I think these are the stocks which are sort of really batting for the bank nifty. And if you're a bull, you don't want to see the Friday's data getting extrapolated this week as well. Same is the case with the NBFCs. You have the Bajaj Finance, the Muthoot Finance and Manappurams of the world, which are at all-time highs. And you have the housing finance and the the weaker
DHFLs of the world,
DHFL of the world, the RELCAPs of the world, which are at 52-week low, in certain cases lifetime low. This is the bipolar nature of the market in the financials. And if you're a bull, you don't want to see even the stronger stocks correct. The problem for the stronger stocks is that a Bajaj Finance, a Muthoot, or all these stocks are now trading at such elevated valuations. And valuation is also, overvaluation is as big a sin in market as any. And at some point that will correct. Even in stocks like HDFC and HDFC Bank, these are lifetime high valuations for good reason. But, purely from the risk reward point of view, again, you want to justify another 10 to 20% move in the near term for these stocks? Perhaps not.
I just want to add one more point on the retaliatory tariff issue. I think we'll just have to wait and see. If the market knows there's no escalation, then perhaps it's a non-event from here on. But the question is it going to be a non-escalation kind of a situation? Now, the tariffs come in on 28 goods. It's not new, it's not surprising. The total value of exports being hit perhaps out of the US is about $1.3 billion. The total trade between India and US is around $55 billion. Now, but what has been targeted? I mean, soft spots. India has really gone for the soft spots. India is among the largest buyers of US almonds, US apples, all the Washington apples that we see in our markets right here. And these are the kind of commodities that have been attacked. There is no mention of the very sensitive Harley Davidsons or the super premium motorcycles, at least in this list of 28. All eyes will, of course, be on the G20 meeting, because we're not just watching out for what the US and Chinese parlays now have to tell us. We need to know if there'll be anything exchanged between President Trump and Prime Minister Modi. So as of now, perhaps the market will take it in its stride. But in case there is any hint of counter retaliation or more rhetoric, maybe it'll be just unnecessary noise for the market.
Okay, well, it's sentiment as well, right? That got hit. The trade wars have come closer home now, so there's definitely some, bit of concern there. But let's do one thing. Let's kickstart the show on that note and tell you what our wise experts have to say as we head into trade this morning. Alexander Redman of Credit Suisse says that since late April, a confluence of market negative developments, albeit with a common denominator, has interrupted their 2019 mid to late cycle recovery thesis for emerging market equities. He says given the nature of market disruption and the capacity and their belief in the underlying willingness for political resolution, Credit Suisse continues to interpret the current malaise as an intermission rather than a conclusion of the emerging market investment cycle. He says their core view remains that there will ultimately be a resolution to the US-China trade war. Thus, he maintains their year-end 2019 target for the MSCI Asia ex-Japan index at 1150, offering a 10% potential US dollar upside from current levels.
Okay, let's get you some money market views as well. B. Prasanna of ICICI Bank says a host of global central bank meetings, including US Fed, ECB, BOJ and BOE, will guide the foreign exchange market this week. He says the market is anxious to see the outcome of US Fed amid expectations that the central bank could flag plans to ease monetary policy amid persistent worries over economic fallout from the trade war. He says the US FOMC future guidance will set the tone for dollar in the near term ahead of the G20 meeting during later part of this month. Prasanna adds the Indian rupee continues to trade in a narrow range amid suspected RBI intervention at lower levels. He expects the pair to trade in the range of 69.40 to 69.95 for this week.
And B. Prasanna says a surprise additional OMO announcement for the current month has further cemented the accommodative stance of the RBI amongst market participants. Further, he says continued moderation in core CPI and benign global environment is working as a near-term hedge against fiscal worries ahead of the union budget. He says as major central banks, including the US Fed, will announce their monetary policy this week, focus will remain on the movement in global yields this week. He expects a 10-year benchmark bond yield to trade within a range of 6.87 to 7% during this week.
All right, so let's take a look at the global cues this morning. Trade tensions continue to dominate the headlines. Nigel is here with the world view.
Well, the U.S. markets headed in the red in Friday's trading session with the NASDAQ. That was the relative underperformer in trade on Friday. This week is going to be a big week in terms of central banks. You have the U.S. Fed, the Bank of Japan, as well as Bank of England. All of them do meet. So central bank action as well as commentary is going to be very, very crucial. Now, in terms of, the stock that was in focus in Friday's trade itself in the U.S. markets, Broadcom, that was down nearly around 5% approximately. They posted a weak top line. They cut its guidance as well going ahead. They say the demand is weak, and in fact the crackdown on Huawei, that's what weighing on them, and that's why the NASDAQ, that was down close to around 0.5%, while you had the Dow that was down only around 0.1% or thereabouts. In terms of economic data that's coming out of there, retail sales grew by close to around 0.5% odd. Expectations were for a number of around 0.6%. In the next couple of days, crucial focus on the FOMC. Are they going to go ahead and cut interest rates? That's what the street is asking. But the dollar index was hovering around the 97 odd mark. That's moved to around 97.5 odd mark. So that's giving you a sense maybe the rate cut will be pushed down to the later meetings in this year itself. European markets as well ended in the red in Friday's trading session. You had all the three frontliners in the red on the back of the trade tensions as well as geopolitical tensions that are playing out in those markets itself. Moving on, then this week itself, you have crucial triggers. One is going to be the geopolitical tensions. Remember, demand is so weak that we had crude move towards $63 per barrel, couldn't hold out there. In fact, in the last week, crude oil prices were under tension. These are the broad cues for this week itself. Asian markets trading in the green, while you have the SGX Nifty indicating a bit of a flattish stack. Back to you guys.
Okay, Nigel, thanks a lot. Arvind Sanger is with us, Managing Partner of Geosphere Capital Management, joining us from New York. Arvind, hi, good morning. Thanks a lot for joining us. So the market dealing with a lot of uncertainties. On Friday we had fresh trade issues between India and the US now. Your thoughts on whether the Indian market needs to correct more from these levels?
Well, I think that the Indian market is not that sensitive to these trade tensions. It's not a big deal in terms of the Indian, if I look at the major companies in the Indian index. So it's a modest negative, but I think it's not a huge issue for India. I think the bigger concern is the bigger trade moves going on globally are likely to be a headwind for global growth, and that is a negative for the Indian market.
Okay, fair enough. Arvind, hi, good morning from India. The next big event that global market watchers are going to look forward to is the FOMC meeting that kickstarts tomorrow. If there are indications of a rate cut, but no rate cut announcement in June, and if there's an expectation that it could come through in July, how do you think global markets would react, and what's your view on how India would take all of this?
You're talking about the Fed rate cut? First of all, I think it's unlikely the Fed moves in June, but you never know. I think a Fed rate cut would be a positive for markets because it would show liquidity easing quicker than expected. So I think that would be a short-term boost for the market. But you have to be careful about these kind of sugar highs, because that's what I would call a Fed rate cut, because it doesn't, obviously it protects against economic slowdown, or tries to protect. But my concern is the global unraveling of the free trade system, which is frankly what we're seeing on a slow medium-term basis, is something that is going to remain a risk for economies, and Fed cutting rate isn't going to magically offset that, but it would help the markets in terms of at least showing that the Fed is paying attention to the risks of growth from trade tensions. I think that's the biggest concern the market has, is that we're seeing a mid-cycle slowdown, or a late cycle, I shouldn't say mid-cycle. This cycle has been going on for 10 years now, but we're seeing a late cycle slowdown synchronized across U.S., China, Europe, India, and other emerging markets. So Fed cutting rates would show that central banks are paying attention and are willing to take corrective action. But I don't think that they magically prevent the slowdown from playing out, but they do improve a little bit more of confidence in investors.
Arvind, good evening to you. And in addition to a lot of these slowdown issues, we here in India are also grappling with certain companies or certain entities which have their own set of issues. And I'm talking about the likes of Yes Bank, whether it's DHFL, the entire ADAG pack. By the way, auditors in one of those companies have said that they simply cannot take a view on results because information is missing. My question is this: we would want to believe that these will be limited to individual companies and stocks, and the market should hopefully move on beyond them. But do you see that happening in the near term?
Well, if it were only a financial market concern, we could move on from there. But the problem is that it has now affected the real economy, as we've talked in the past and as you've seen in the data. Whether it's auto sales or it's commercial vehicle sales or even FMCG products, we've seen sales across various parts of the economy slow down significantly, and we're seeing multi-year kind of lows in terms of the magnitude of sales slowdown. So I think what we have is a problem here that is not just confined to a few problem NBFCs and a few banks that have exposure to those problem NBFCs, but the whole liquidity crisis is now starting to affect consumer confidence in addition to obviously business confidence. And so I think this requires some serious corrective action, both on the fiscal and on the monetary front. And, RBI cutting rates by 25 bips as they did, a few days ago is clearly not sufficient in and of itself to correct this swoon in the economy. So I think we're looking for more actions, which suggest that the problems are being contained and liquidity to the healthier NBFCs and to the overall economy is being reignited, and I think that's the real concern in India.
Okay, Arvind, the other point about Indian market is it's been so narrow. Take out 8 to 10 stocks, and you are looking at practically a bear market. It's already visible in the broader market, and post-election result, there was a hope rally that we had in the mid caps, and that's really gone now. Do you think there's a risk to say domestic inflows into the market because of this consistent underperformance of the broader market?
Absolutely. I think we're clearly in a bear market for most mid and small cap companies, and I think that clearly reflects HNIs and retail investors. Not everybody owns the 7 or 8 names like you mentioned that have been leading the major index higher or major 1 or 2 indices higher. So I think that is clearly showing a lot of concern about the broader. I think there are 2 concerns, if I can put it broadly. One is the economic outlook, and the other is concerns about the quality of the managements and the hidden problems. And we've seen that whether it is in some of the groups that you named where liquidity problems, but we've seen a lot of other examples where promoters have borrowed money and got into trouble. So there's a lot of cockroaches coming out of the cupboard in terms of problem mid-cap and small-cap names, and I think that's making investors risk-averse. Eventually, this will prove to be a great buying opportunity because you are going to see the baby thrown out of the bathwater in terms of high-quality companies getting sold off. But I don't think that the all-clear sign has been signed yet, and I think there's a lot of hope that people are riding on this upcoming budget. But I think this is not a budgetary problem alone. I think this is more of coordinated action by fiscal and monetary authorities to revive confidence and to get liquidity back in the system. And I don't see any clear indication of what's coming, but I'm hopeful that the government is apprised of the situation.
Actually, that seems to be the problem in the financial space as well, right, Arvind? Because it's so bipolar in nature. On one hand, you have a skeleton stumbling out of the closet every day with names like Yes Bank, IndusInd Bank, etc. On the other hand, you have marquee names like Kotak, HDFC that continue to hit new highs. But on Friday, we did see some sell-off even in these blue chip names. So how do you approach financials, private sector banks now?
Well, I think, first of all, there's a risk that the indices that have been holding up, if the overall indices crack, then the high-quality names, are not going to stay at such elevated valuations relative to the rest of the market because the gap has gotten so large that at some point here, the valuation differentials are probably unsustainable. So that's the risk in hiding in a very narrow group of names that eventually they will give way to gravity. On the other hand, if you do get any kind of to me, the risk reward is not that favorable in those high quality names because if you do get some corrective action by the fiscal and monetary authorities, then you could get a rally in the laggards, some of the higher quality but not quite as blue chip names which are oversold, could benefit. But on the other hand, if it doesn't happen, then the market could sell off. So I don't think this is a market in which you hide. I think this is a market in which you patiently look for signs of recovery, and then the mid caps will give you the opportunity to buy.
All right, Arvind, we'll leave it there today. Thanks a lot for taking this call for us.